Welcome back to Wealthwise, the podcast where clarity meets strategy, and where we navigate the often confusing world of personal finance and wealth creation together. I'm your host, Sarah. There's a feeling a lot of us have been grappling with lately, that almost intangible sense that something's off with the economy. We hear the official reports, the data points, but then we look at our own bank accounts, our career paths, the rising cost of just living, and there's a disconnect. It's like we're being told one story, but experiencing another. So today, we're not just acknowledging that feeling, we're dissecting it. We're diving deep into a crucial topic, the unspoken truth about our economy, why it feels broken, and how you can still build real, lasting wealth. And to guide us through this complex landscape, I am absolutely thrilled to have the brilliant Max Wise with us today. Max isn't just a seasoned financial strategist. He's a highly respected wealth educator, known for his incredible ability to cut through the jargon, expose the underlying mechanics of our financial systems, and offer battle-tested strategies that actually work in the real world. Max, it's an honor to have you. Over the course of our conversation, Max is going to help us unpack three critical areas. First, we'll explore why those official economic indicators often feel so out of sync with our personal financial realities. Second, he's going to pull back the curtain on what some call the money game, the fundamental principles the wealthy understand and utilize to grow and protect their assets. And most importantly, Max will share three foundational, actionable principles that you can start implementing today, not just to survive these uncertain times, but to genuinely thrive and build a secure financial future, regardless of what the broader economy is doing. Max, welcome officially to Wealthwise. It's fantastic to have you on the show. So let's just dive straight in. This disconnect we're talking about, the official data often painting a picture of, say, a booming job market or rising incomes, while so many individuals are feeling the squeeze from inflation, the daunting cost of housing, or anxieties about their job security, it creates a real sense of unease. In your experience, why is this topic, this pervasive feeling of economic dissonance, so widely felt, yet often so misunderstood?
Sarah, thanks so much for having me. It's a pleasure to be here. And you've hit on an incredibly important point right out of the gate. That dissonance is very real, and it's not just in people's heads. You see, we're constantly bombarded with macroeconomic data, GDP growth, unemployment rates, inflation targets. And on the surface, these numbers might look, if not always stellar, then at least stable or improving. But the lived experience for a vast number of people, especially those in the 18 to 40 demographic who are trying to build their careers and financial foundations, often tells a different story. For instance, a recent report from Northwestern Mutual highlighted that a significant majority of Americans feel their income simply isn't keeping pace with inflation, despite what headline wage growth figures might suggest. Yahoo Finance regularly features articles on the almost insurmountable challenge of buying a home for young people in many major cities. I even recall a CNBC piece not long ago that bluntly stated, "The job market is trash right now," from the perspective of many job seekers. This creates a cognitive dissonance. The experts say things are okay or even good, but my reality feels very different. What am I missing? It leads to a lot of frustration and anxiety. One of the most common misunderstandings, Sarah, is the simplistic equation of a higher salary equals more wealth. People chase that promotion, that pay raise, and rightly so, but they often overlook the silent erosion of purchasing power due to inflation. Let's take a concrete example. Over the last 5 years, let's say from roughly 2020 to early 2025, the reported cumulative inflation in the U.S. has been around 24.2%. Now, if the median household income grew by, say, 22% in that same period, which would be a decent nominal increase, the reality is that the average person is actually poorer in real terms. Their money buys less. They're running faster just to stay in the same place, or even fall slightly behind. Another pervasive myth is the idea that just working hard at your job is enough to get ahead. While hard work is undeniably crucial, the fundamental structure of our economic system is often misunderstood. Publicly traded companies, for example, have a fiduciary duty, a legal obligation to their shareholders. The employees, from the CEO down, are there to create value that ultimately benefits those shareholders, the owners of the company. It's not an indictment, it's just the design of the system. So if you're only an employee and not an owner or investor in some capacity, you're on one side of a wealth transfer equation that is inherently tilted towards capital. And this is not a new phenomenon. If we zoom out and look at the longer-term data, it becomes even clearer. Consider the last 50 years, from roughly 1975 to 2025. The price of the median car in America has gone up by something like 840%. The median house price, that's skyrocketed by around 1,200%. And the cost for a single year at a public university has exploded by about 2,000%. Now, how does that compare to incomes? According to data from the Bureau of Labor Statistics, the median household income in America has increased by approximately 600% over those 5 decades. Yes, incomes have risen, but the cost of major life essentials has risen at a far more dramatic pace. But here's the real eye-opener, Sarah. During that exact same 50-year period, the stock market, as represented by the S&P 500, has grown by roughly 4,000%. It's what I often call the tale of two classes. You have the investing class, who are benefiting from the compounding growth of assets, and then you have many in the wage-earning class who, despite their best efforts, are finding it increasingly difficult to get ahead because their primary source of financial growth, their income, is being outpaced. So when people feel that squeeze, that anxiety, it's often because they're experiencing the sharp end of these long-term trends. They sense that the traditional playbook of get a good education, get a good job, work hard, isn't yielding the same results it might have for previous generations. And they're not wrong.
That's a powerful and somewhat sobering analysis, Max. You've laid out very clearly how these larger economic forces and systemic designs can create that gap between perception and reality. It really underscores why understanding these dynamics is so crucial. So, if the system is, as you've described, structured in a way that disproportionately rewards asset ownership, the natural and perhaps urgent question for our listeners is, how can the average person who might be starting with very little capital begin to shift their approach? How can they move from being solely reliant on earned income to actually building ownership and leveraging these principles to their advantage? And I think that sets us up perfectly for the next part of our discussion, where we'll really get into the core insights, those actionable strategies you mentioned. Max, you've painted a very clear picture of the economic landscape and why so many people feel that disconnect. It really highlights that the traditional advice, while well-intentioned, might not be sufficient anymore. You mentioned the system seems to inherently favor investors and asset owners. Could you elaborate a bit more on this playing field, specifically on the elements that the average person, the everyday worker, might not be fully aware of, but that significantly impact their ability to build wealth?
Absolutely, Sarah. And playing field is a good analogy because, like any game, understanding the rules, the biases, and the incentives is crucial to playing it effectively. There are a few key structural elements that many people overlook. First, let's talk about something called fiduciary duty in the corporate world. When you work for a company, especially a publicly traded one, the CEO and the board of directors have a primary legal and ethical obligation of fiduciary duty to maximize shareholder value. That means their core mission is to make the owners of the company, the shareholders, richer. Your hard work, your innovation, your dedication as an employee, these are all vital inputs, but they are ultimately channeled towards that primary goal. It's not malicious, it's just the design. So if your only relationship with the company is as an employee, you're essentially a resource contributing to the wealth of others. The shift happens when you also become an owner, a shareholder, even in a small way. Second, and this is a big one, is the tax system. The federal income tax code in the U.S. is notoriously complex. We're talking thousands of pages. But within that complexity, there's a pattern. The system is generally structured to offer more favorable treatment to income derived from investments and business ownership than to wage income. For instance, a W-2 employee, someone earning a salary, can face federal income tax rates as high as 37% on their top earnings. They pay taxes on their income before they get to invest what's left. Now, compare that to long-term capital gains, profits from selling an investment held for more than a year. The top federal tax rate on those is currently 20%. That's a significant difference. Furthermore, investors, particularly in areas like real estate, have access to a whole suite of deductions and tax strategies like depreciation, 1031 exchanges, that can dramatically reduce their taxable income, sometimes even to zero, legally. So an investor might make $1 million and pay a lower effective tax rate than an employee making a quarter of that. It's not about evading taxes, it's about understanding and utilizing the incentives the code provides for certain types of economic activity, predominantly investment and entrepreneurship. And third, there's what I call the hidden tax, which is inflation, and how it's often fueled by government policy. When governments spend more money than they collect in taxes, which results in deficit spending, they often have to borrow money to cover the difference. Think about the massive stimulus packages or infrastructure projects. In 2024, for example, the U.S. government is projected to spend about $1.8 trillion more than it takes in. Where does that money come from? A significant portion can effectively be created by the central bank, like the Federal Reserve, which then lends it to the government. This injection of new money into the system without a corresponding increase in goods and services dilutes the value of all existing money. That's inflation. Now, who does inflation hurt the most? It hurts savers holding cash because their cash buys less over time. It hurts people on fixed incomes. It hurts wage earners if their pay doesn't keep pace. But who can it benefit? Asset owners. The price of tangible assets like real estate or productive assets like stocks in good companies tends to rise with inflation, often even outpacing it. So while your paycheck might be buying less at the grocery store, the value of your investment portfolio or your rental property could be increasing. This subtle but powerful mechanism continuously transfers wealth from those who primarily hold currency to those who primarily hold assets.
That's a fantastic breakdown, Max. Understanding those three elements, fiduciary duty, the tax system's leanings, and the impact of inflation, really shifts the perspective on how wealth is or isn't accumulated.
Precisely. And it leads to a fundamental realization. The economic system isn't rigged against you. It's simply designed with rules that reward certain behaviors, primarily ownership and investment. The critical question isn't how to fight the system, but how to understand its rules and position yourself to benefit from them.
So, Max, that brings us to a really crucial point. If the system is indeed designed to favor owners and investors, as you've so clearly laid out, how does an ordinary person, someone who's maybe starting with little to no capital, perhaps just their paycheck, begin to make that pivotal shift in both mindset and action to become an owner in this system? It can feel like a monumental leap for many.
It can feel monumental, Sarah, but it's more about a series of deliberate, consistent steps than one giant leap. And it starts with what I call golden rule number 1, work to S.O.W. That is, strive for ownership and wealth. Don't just work to earn. Let me break that down. The vast majority of people operate on a linear financial model. 1, earn money from a job. 2, pay taxes, often the highest rates, as we discussed. 3, spend money on lifestyle, liabilities, consumption. And then if there's anything left, they wonder where it all went, or maybe save a little. Their primary thought process around increased income is usually, if I make an extra $10,000 a year, what bigger car can I lease? What nicer vacation can I take? It's an earn-to-spend cycle. The wealthy, or those on the path to becoming wealthy, operate differently. Their model looks more like this. 1, earn money from a job, a business, or initial investments. 2, invest money strategically to acquire income-producing or appreciating assets before major discretionary spending. 3, optimize taxes legally through the structure of their investments and income. 4, spend money, often from the cash flow or profits generated by their assets or by borrowing against appreciated assets at low rates. Their primary thought process around increased income or any capital is, if I have an extra $10,000, what asset can I buy that will work for me? How can I put this money to work to generate more money or grow in value? So, what are these assets I keep talking about? Historically, the 3 primary wealth-building vehicles have been stocks, equities, owning shares in publicly traded companies. This is by far the most accessible for most people. You can start with very small amounts through index funds, ETFs, or even individual stocks. You're literally buying a piece of a business. Real estate, owning physical property, whether it's a rental unit, commercial property, or even RETs, real estate investment trusts, for smaller scale participation. This often requires more capital and know-how upfront, but offers benefits like leverage, cash flow, and significant tax advantages. Starting or owning a business. This is the most active and often the highest potential return and risk category. It's about creating an entity that solves a problem or provides a service, generating profits that you, as the owner, control. The key is to systematically allocate a portion of your earned income towards acquiring these types of assets, consistently over time. It's about shifting from being purely a consumer to also being an owner. Even if you start small, $50 or $100 a month into an index fund, you're beginning to plant those seeds of ownership.
That strive for ownership and wealth, S.O.W. acronym, is powerful. It reframes the purpose of earning entirely.
Exactly. It's about planting seeds for your future self. Your salary can help you survive and live comfortably, but it's the assets you acquire and grow that will build true, lasting financial freedom. Make your money work for you, not just through you.
That transition from an earn-to-spend to an earn-to-own mindset is fundamental, Max. But I can already hear some listeners thinking, okay, I get it, owning assets is key, but it sounds hard. And frankly, it's very tempting to enjoy the fruits of my labor now. Many people get caught in the trap of wanting to look rich, or they're simply overwhelmed and perhaps even scared by the perceived risk of investing. What advice do you have for navigating these very human tendencies and fears that often prevent people from taking those first steps towards ownership?
Those are incredibly valid points, Sarah, and they lead directly to the next 2 golden rules. Golden rule number 2 is aggressively say no to fake rich and lifestyle creep. We live in a society that bombards us with images of success, often equated with material possessions. It's remarkably easy, especially with readily available credit, to look like you've made it long before you actually have. The BMW you can barely afford the payments on, the designer clothes financed on a credit card, the lavish vacations that leave you in debt. This is what I call fake rich. To combat this, you need strong financial discipline. Stop financing depreciating assets or pure consumption. Your new smartphone, your car, unless it's a tool directly generating income for a business, your clothes, your holidays, your furniture. If it doesn't put money into your pocket or significantly increase in value, strive to pay cash for it. If you can't afford it outright with cash without derailing your saving and investment goals, you either need to buy a cheaper alternative or wait until you can. Those easy monthly payments of $30 or $300 a month are insidious. They numb you to the true cost and keep you on the consumption treadmill. Implement a rule for luxuries. A practical one I often suggest is my rule of 5. If you can't comfortably afford to buy 5 of that luxury item with cash without it impacting your financial stability or investment plan, then you can't truly afford one of them. So, you want that $10,000 Rolex? You should ideally have $50,000 readily available and not earmarked for essential investments before you even consider it. This acts as a strong psychological check against impulsive, status-driven purchases. Then comes golden rule number 3. Embrace the reality that no risk equals no meaningful return. The fear of losing money is potent, especially when you've worked hard for it. And let me be clear, investing always involves risk. You are never guaranteed to make money. In fact, you will lose money on some investments at some point. I have. Every successful investor has. But the crucial understanding here is that avoiding all risk by, say, keeping all your money in a low-interest savings account also guarantees that your money will likely be eroded by inflation and will never significantly grow. You're trading the potential for growth for a false sense of security. The goal isn't to avoid risk. It's to understand it, manage it, and take calculated risks. Losses are tuition. Think of early investment mistakes or small losses not as failures but as real-life tuition. You're paying to learn how markets work, how your own emotions react to volatility, and how to make better decisions next time. If you're not willing to go through some of these learning experiences, you'll never see the significant upsides. Diversification and long-term perspective are key risk mitigators. Don't put all your eggs in one basket. Invest across different asset classes, geographies, and industries, and understand that true wealth building is a marathon, not a sprint. Short-term market fluctuations are noise. Long-term growth is the signal you should be focusing on. It's about building resilience and understanding that setbacks are part of the journey to success. The fear of making a mistake can be more damaging than the mistake itself if it leads to inaction.
The rule of 5 is a really practical filter for luxury spending, and reframing losses as tuition is a powerful way to manage the fear of investing.
It's about separating true wealth from the appearance of wealth and understanding that growth requires stepping out of your comfort zone. Authentic wealth isn't about what you show, it's about what you own and the financial security it provides. And building that ownership requires the courage to defer gratification and embrace calculated risk as the price of admission to real growth.
These golden rules, striving for ownership, saying no to fake riches, and embracing calculated risk are incredibly insightful, Max. They provide a strong philosophical foundation. Now, for our listeners who are nodding along, feeling inspired, and ready to make a tangible change, what's the first concrete, actionable step they can take today or this week to start implementing these principles and build a more effective money management system for themselves?
This is where the rubber meets the road, Sarah. Abstract understanding is great, but execution is everything. The most impactful first step is to design and implement a clear, automated money system. It doesn't have to be complicated. In fact, simpler is often better. A system I often recommend, especially for those starting out, is a variation of the 75-15-10 plan. 75% maximum for spending. This covers all your living expenses: housing, food, transportation, utilities, and discretionary spending. The key here is maximum. If you can live on less, even better, as that frees up more for the other categories. 15% minimum for investing. This is non-negotiable. This portion of every dollar you earn goes directly towards acquiring those assets we talked about: index funds, stocks, contributions to a real estate fund, etc. This is your wealth-building engine. 10% minimum for savings, emergency fund, or short-term goals. This is your financial safety net. This money is for unexpected emergencies, a job loss, a medical bill, urgent home repairs. You build this up until you have 3 to 6 months of essential living expenses covered. Once that's full, you can redirect more from this category to investing or larger planned purchases. The magic ingredient here, Sarah, is automation. 1. Set up separate bank accounts. Ideally, you'll have at least 3. A checking account for your 75% spending, your regular bills get paid from here. A brokerage or investment account for your 15% investing. A high-yield savings account for your 10% savings, emergency fund. 2. Automate your transfers. As soon as your paycheck hits your main account, set up automatic transfers to move the 15% to your investment account and the 10% to your savings account. Do this before you pay any bills or spend anything. This is the essence of paying yourself first. If your bank charges fees for these basic accounts or transfers, find a new bank. There are plenty of free options. Think of this system as creating your own wealth-building tax. The government automatically takes its taxes from your paycheck before you see it, right? Why? Because they know if they sent everyone a bill at the end of the year, compliance would be much lower. People spend what's available. You need to apply that same psychology for your own benefit. By automating the allocation to savings and investments, you remove the temptation and the discipline burden. The money for building wealth is gone before you have a chance to spend it on something less impactful. When that investment money is in a separate account, you're less likely to dip into it for everyday expenses. And your savings account is there to protect your investments from being liquidated prematurely during an emergency. This simple structure creates clear boundaries and automates good financial habits. It will feel a little tedious to set up, yes, but I promise you, it will fundamentally change how your money works for you over time.
Automating the 75-15-10 plan with separate accounts, that makes so much sense. It takes the daily decision-making and willpower out of the equation.
Absolutely. You're building a system for success, rather than relying on finite willpower. Stop trying to manage your money with willpower alone. Instead, automate your wealth building. A well-designed system will always outperform inconsistent discipline. Pay yourself first, automatically, and your future self will thank you profoundly.
Max, the clarity you've brought to understanding our economic system and those golden rules for building wealth, striving for ownership, saying no to fake rich, embracing calculated risk, and automating our financial habits, it's all incredibly powerful. You share these principles with such conviction and a depth of experience that's palpable. It makes me wonder, because we often learn our most profound lessons not just from successes, but from the challenges we overcome. Was there a particular turning point in your own financial journey, Max? Perhaps a significant failure, a costly mistake, or a breakthrough moment that fundamentally reshaped how you think about money, risk, and the path to wealth? I think our listeners would really benefit from hearing a more personal side of that journey.
That's a great question, Sarah, and absolutely. Theory is one thing, but the battlefield of real-world application, especially when your own hard-earned money is on the line, teaches lessons that no textbook ever could. For me, there was one particular real estate deal early in my investing career that I often refer to as my million-dollar education. Though, thankfully, it didn't cost me $1 million. The lessons felt that valuable, and at times, that painful. It was a small multifamily property, a duplex, in what I thought was an up-and-coming neighborhood. I'd done my spreadsheets, run the numbers, and on paper, it looked like a solid investment. Decent cash flow potential, good appreciation prospects. I was eager, perhaps a little too eager, to get my feet wet in quote-unquote real estate beyond just REITs. And Sarah, almost everything that could go wrong with that deal did go wrong. My due diligence, in hindsight, was superficial. I hired the wrong contractor for some initial renovations, a guy who was cheap, promised the world, and delivered very little besides delays and shoddy work. This led to a cascade of problems. The renovation took twice as long and cost nearly double what I'd budgeted. Then came the tenants. My screening process was lax. I ended up with one tenant who consistently paid late and eventually had to be evicted, which is a stressful and costly process in itself. The other tenant, well, let's just say they weren't exactly respectful of the property, leading to more repair bills. And just when I thought things couldn't get worse, a city inspector flagged an issue with some of the previous owner's unpermitted work, something my initial inspection had missed, requiring another expensive fix. There were nights, Sarah, I genuinely lay awake just staring at the ceiling, my stomach in knots, thinking, What have I gotten myself into? I should just cut my losses, sell this thing even at a loss, and stick to index funds. The financial strain was intense, but almost worse was the feeling of incompetence, of having made so many poor judgments. The allure of passive income felt very, very distant at that point. It felt like active pain. The temptation to just give up on real estate investing entirely was immense. I thought, maybe this isn't for me. Maybe I'm not cut out for this level of risk and headache. The breakthrough wasn't a single aha moment, but more of a gradual, hard-won shift in perspective. Firstly, I realized I had to take radical ownership of every single mistake. It wasn't just bad luck. It was poor due diligence, insufficient experience, and perhaps a touch of greed in wanting to get into the game quickly. Secondly, I started to meticulously deconstruct every error. Why did I choose that contractor? What red flags did I ignore? How could my tenant screening be better? What systems did I need to put in place for property management, even for a small duplex? Instead of just selling it off in a panic, I decided to treat it as an intensive real-world MBA in property management and renovation. I fired the bad contractor, which was another difficult conversation, found a more reputable, albeit more expensive one to fix the issues properly. I learned the eviction process inside and out. I educated myself deeply on local building codes. I got my hands dirty, literally and figuratively. It took another year of stress and pouring more money into it than I ever anticipated, but eventually I managed to stabilize the property, get good tenants in, and get it cash flowing positively. The key lesson, the one that fundamentally changed me, wasn't just about real estate tactics. It was about resilience, the critical importance of deep due diligence, and the understanding that significant learning often comes disguised as painful failure. It taught me that setbacks are inevitable in any worthwhile endeavor, especially in investing. The question isn't whether you'll face them, but how you respond. Do you quit, or do you learn, adapt, and persevere? That property, which was once the bane of my existence, eventually became a decent investment, but more importantly, it became the foundation of experience upon which I built a much larger, much more successful portfolio later. I realized that if I had quit then, I would have internalized the lesson that I can't do this, rather than I can learn from this and do better. It taught me that those tuition payments, as painful as they are sometimes the most valuable investments you can make in your own capabilities.
Wow, Max, thank you for sharing that so openly. That's such a powerful story of turning what sounds like an absolute nightmare into a profound learning experience. That idea of real-life tuition and the resilience built through it, I think, will resonate deeply with anyone who's ever faced a significant setback, financial or otherwise.
Wow, Max, thank you for sharing that so openly. That's such a powerful story of turning what sounds like an absolute nightmare into a profound learning experience. That idea of real-life tuition and the resilience built through it is something I think will resonate deeply with anyone who's ever faced a significant setback, financial or otherwise.
That's a fascinating question, Sarah, because the pace of change is accelerating. If I had to bet on one overarching shift, it would be the accelerated democratization and personalization of sophisticated financial strategies and tools, largely driven by technology, particularly AI, coupled with an increasing emphasis on verifiable financial literacy. I call it the rise of empowered financial self-sovereignty. For decades, access to sophisticated investment analysis, alternative asset classes, and highly personalized financial planning was largely the domain of high-net-worth individuals and institutions, often gated by expensive human advisors or high investment minimums. That's rapidly changing. We're already seeing AI-powered platforms that can provide incredibly detailed market analysis, portfolio optimization, and even robo-advisory services at a fraction of the traditional cost. Think about tools that can help an average investor analyze a company's fundamentals as deeply as a Wall Street analyst could a decade ago,
or platforms that allow fractional ownership in previously inaccessible assets like commercial real estate, private equity, or even collectibles. This isn't just about lower costs, it's about a fundamental shift in access to information and capability. In the next 3 to 5 years, I anticipate AI will become even more integrated, offering hyper-personalized financial guidance. Imagine an AI financial mentor that understands your specific goals, risk tolerance, income, spending habits, and tax situation, and can provide real-time actionable advice like, based on your current savings rate and market conditions, you're on track for your retirement goal, but consider rebalancing X portion of your portfolio to Y to optimize for Z. However, this explosion of access and tools comes with a crucial caveat: the need for enhanced financial literacy and critical thinking. With more information and more choices, the ability to discern good advice from bad, to understand the risks inherent in new asset classes, and to avoid sophisticated scams becomes even more critical. So, alongside the tech-driven democratization, I see a parallel trend, or perhaps a vital necessity, for more accessible, engaging, and verifiable financial education, not just generic advice, but education that empowers individuals to truly understand the why behind financial strategies, not just the what. So, the individuals who will likely achieve greater financial success in the coming years are those who embrace these new tools, yes, but more importantly, those who commit to continuous learning, who cultivate the ability to think critically about financial information, and who take proactive ownership of their financial education and decision-making. It's less about finding the hot stock, and more about building a robust, adaptable financial framework for themselves, leveraging technology as an amplifier, not a crutch. Financial self-sovereignty isn't just about having access, it's about having the competence and confidence to navigate that access wisely.
Empowered financial self-sovereignty. I love that term. It paints a future where individuals are less reliant on traditional gatekeepers and more equipped to chart their own financial destinies, provided they invest in their own knowledge. That's a very hopeful yet challenging outlook.
Max, this has been an incredibly enlightening and empowering conversation. From demystifying the economic disconnect many of us feel, to laying out those actionable golden rules for wealth building, to sharing your own powerful story of learning from setbacks, and now looking at the future of empowered financial self-sovereignty, you've given us a wealth of wisdom. For everyone listening, if I could attempt to distill some of the core takeaways from today's discussion with Max, first, understand the playing field. Our economic system and tax codes often favor asset ownership and investment. Knowing this isn't about being cynical, it's about being strategic. Embrace the mindset of S.O.W, striving for ownership and wealth. Shift from solely earning to spend to consistently earning to own. Live authentically. Say no to fake rich and the pressures of lifestyle creep. True wealth is about security and freedom, not just appearances. Understand that calculated risk is essential for growth. View mistakes as tuition on your journey to financial competence. And finally, automate your financial system. Make saving and investing your default, not an afterthought. Pay yourself first. Max, thank you once again for your generosity, your insights, and your time today. It's been a privilege.
The pleasure was all mine, Sarah. Thanks for having me and for facilitating such a great discussion.
And to our amazing WealthWise community, if you found value in today's episode, and I truly hope you did, here are a few simple ways you can support the show and help spread this knowledge. First, share this episode with a friend, a family member, or a colleague, anyone you know who's looking to gain more clarity and control over their financial future. A simple share can make a big difference. Second, if you haven't already, please subscribe or follow WealthWise on your favorite podcast platform. This ensures you won't miss out on our upcoming conversations designed to bring you weekly breakthroughs. And finally, we'd love to hear from you. Leave us a rating and review, or connect with us on our social media channels. Let us know what resonated with you from today's episode, or suggest topics you'd like us to cover in the future. Your feedback is invaluable. Thank you for tuning in to WealthWise. Remember, building wealth isn't just about numbers. It's about designing a life of freedom, choice, and impact. Until next time, keep seeking clarity, keep building your strategy, and never forget this: financial freedom isn't just a distant dream. It's a destination you reach, one informed decision, one disciplined action, and one wise investment.